What's going on, everybody? Welcome back to our Becoming an Apex Trader series. Today we're going to be talking about indicators. This will be the third part in our 5-part series. We started off with candlesticks. We moved on to market structure. Now we're going to do indicators. The next episode will be on volume profile. And then finally, we will close it up with order flow. So before we get started, just a quick recap for the giveaway. We will be giving away Apex accounts, Addis accounts, Discord access, and a $3,500 laptop. So up to this point, I didn't really give you guys details on the laptop giveaway, but yes, it will be about a $3,500 laptop. It will be a 16-inch, 240 hertz laptop with a 5080 NVIDIA GeForce graphics card. It's going to have 32 gigs of RAM, 2 terabyte M.2. It's going to be a powerhouse, basically. It will be a very good laptop for trading while you're traveling or just using it as a workstation. You could attach some monitors to it for your trading, etc. If you guys want to get into the giveaway, just follow the details on the screen. One thing I didn't clarify on this is just take screenshots of your quote-unquote tickets and then send them to that email at the bottom. So if you comment on the videos, just take a screenshot of it, send it my way. If you have Apex receipts, take a screenshot of them, send them my way, etc. If you're a Discord member, you could send me a screenshot of your Discord username or your receipt when you purchase the Discord access. But all right, guys, let's get started. So starting with a recap from last video, we talked about market structure. We talked about higher highs, higher lows, lower lows, who's in control, types of trades you can take with this market structure, like rollovers, sweeps, that sort of thing. We also talked about some advanced structure using volume profile, which obviously that will make more sense once we get into the volume profile series after this episode. So in today's episode, we're going to be talking about indicators, talking about moving averages, VWAP traps and flags, DBT MoMo, and the Oasis trading suite, and how you can use all this as confluence in your trading. So starting off with moving averages, what are we going to talk about today? We're going to talk about the 8 and 24 technique. If you guys have not seen my 8 and 24 video, I will put it on the screen here in a second. You guys can check that out. But basically what I am talking about with that 8 and 24 technique is the difference between like aggressive traders being in control and responsive traders being in control. So basically, if the uptrend is just a very strong trend or even the downtrend, that you basically don't see any pullbacks and you're like, how do I get in? How do I get involved in this trend? I keep trying to look for a trade, but it's just not really giving me these pullbacks. That is probably the 8 EMA kind of pushing you up. You're constantly breaking into higher highs or you're constantly breaking into lower lows for a downtrend, and you're not seeing that pullback into the more responsive levels around that kind of 20 to 24 EMA area. Now, it doesn't have to be exact. They are kind of their personal preference, right? You could use like an 8 EMA, a 9, a 10, 11, 12, whatever. But what I'm referring to is like a fast moving average. And then for kind of a slower moving average, for more of a responsive area where those pullbacks typically happen, you want to be somewhere around the 20s. So like 20, 21, 24, right? The reason I use 8 and 24 is I started using 8 way back in the day. It was a very common moving average number. And I wanted to use 3 moving averages. I wanted to have what I call a trident. I'd have 3 moving averages where I could kind of see where that pressure was coming in, that buy or sell pressure. So I had 8, 16, and 24. And then over the years, I kind of realized that the 16 was kind of useless. If I had the 8 and the 24, that's all I needed. So I just took away the 16, and now I use the 8 and 24. So it's not like this fancy reason on why I use these averages. That is why I use them. I started with the 8, just had a couple of multiples, 16, 24, took away the 16. All right. Other things we're going to talk about are retests. So when you have like a vertical distribution or a downward accumulation day, how do you trade those days? A lot of the times you'll see that, like I said, you're just kind of like, how do I get into this? I just don't understand how I could be a breakout buyer during a very strong uptrend, but somehow I'm still losing. How do I properly trade this vertical distribution type of day? So we'll talk about looking for those retests and being a more responsive trader during those responsive days, making sure that you are on not only the right side of the market, but you are also following who is controlling that side of the market. Are you bullish aggressive? Are you bullish responsive? That sort of thing. Okay. And finally, with the moving averages, we're going to talk about traps. So when you have these like small breakdowns of these moving averages, but you have those one or two of those patterns, you have that cupping pattern or that V-shaped pattern. Typically, most traps come in those two patterns. If I had to say one was more common, it would be that U-shape, which we'll talk about here in a little bit. But we're going to get into these different kinds of traps and how you can look for them to trade or possibly stay in your trade and not get trapped right out of your trade. We're going to talk about VWAP traps and VWAP flags. So VWAP trap trades, the bull flag into VWAP trade, the bear flag into VWAP, and what I talk about when I mean the danger zone between the two VWAPs, the daily VWAP and the session VWAP. You guys hear me talk about that danger zone a lot on our live streams, and we'll get into what that exactly is, but basically what I'm talking about when I say that is that zone between the daily and the session VWAP. It's kind of like a 50-50 chop zone. We'll talk about that here in a little bit. All right, starting off with some examples on the 8 and 24 moving averages and how I use them in my day-to-day trading. I wanted to show you guys an example of a market shift from kind of a aggressive market into a bit more of like a neutral market and then back into kind of a responsive and then aggressive to the downside. So just kind of shifting through the different types of control. And I think a good example of that was Wednesday, October 15th. And what I wanted to start off with before we get into the exact example here is I use the 8 EMA as the aggressive average, the 24 as the passive average. So what are we actually looking for when we are using them in our day-to-day charting? So basically, if something is aggressive, what you want to think about, and we talked a lot about this in the candlestick and market structure videos, but what you want to think about is if you have kind of that one time framing effect where the candles just keep going one directional and they are breaking one side of the candle, but they are not breaking the opposing side of that candle. For example, in a very aggressive uptrend, they would be breaking the highs of that candle and not really testing the lows. That would be very aggressive to the buy side. When you're looking for this one time frame effect, you're really not looking for it very much on the 1 minute chart. You are going to be looking for this more so on like the 5, the 15, and the 30-minute chart when you're day trading and scalping, right? Because the 1 minute candles, they're so short, they don't last very long, right? It only takes a minute to form them. So they don't really have enough value inside that 1 minute to really give us a strong one time framing effect. If they are one time framing, which we can see a couple of examples here, kind of like right here and then kind of like right here, not exactly. But if they are one time framing on the 1 minute, it's typically extremely aggressive. But normally we will be looking for this on like the 5, 15, or 30 minute. My favorite time frame is the 30 minute, which we will talk about more in the volume profile series video next week, because we're also going to be talking about market profile in that video, and that's kind of a market profile term. But going back to what I was saying is this one time framing effect when the market is moving very aggressively in one direction goes hand in hand with using that 8 EMA in your charting, because the 8 EMA is what I consider the most aggressive average. Basically meaning that if I wanted to be an aggressive trader, if I wanted to follow this trend, I want to be trading around that 8 EMA. I want those candles to be holding above that 8 EMA, and if it is pulling back, I want those pullbacks to be staying above that 8 EMA after retesting. I do not want to see those deep corrections into the 24 EMA or below. That would be an extremely aggressive market. Let me recap that. We are looking for one time framing, mainly on a 5, 15, or 30 minute, and we want that to stay above the 8 EMA on basically every retest. Now, the exception to that rule is we do not want to be trading very far away from the 8 EMA. If I consider the 8 EMA basically the most aggressive value line, that's where like the aggressive traders should be around. They should be around that average. They don't want to be too far away from it. If you get really far away from that level, that line, whatever you want to call it, I would consider that extended. If we look at the high of this day here, Wednesday, you see what this is called air. They call the gap between the price and the average air, right? It's kind of like an open air effect. If there is too much open air between your price action and your EMA, that is not really a good thing, especially if it's on a aggressive average like an 8 EMA like this. So if you have a lot of open air between you and that 8 EMA, it is probably extended, and I probably do not want to be trading as a buyer that far away from the most aggressive buy value, right? If I consider this 8 EMA, which by the way, it's the teal line on my chart, the 24 EMA is the orange line. If I consider this the most aggressive value line, then I want to be a trader around that average if I am being an aggressive trader. So if we're pulling away from that average massively, maybe there's a really big impulsive move that is pushing us away from that average, I don't want to be a trader 10 points away from that average, because if you just look at my chart, look at just this small snapshot of price action that I have on this chart. Look at how many times it pulls back to that aggressive average. So the probability of pulling back to that average is extremely high. So if we understand that that probability is extremely high, why would we want to be a buyer if you're very extended above that EMA? And same thing goes for the downside. Why would we want to be a seller way below that 8 EMA if, like I said, the probability of pulling back to it is so high? Okay, so we want to look for that one time framing nature. We want to look for that very aggressive buyer sell pressure. If it's staying above the 8 EMA, then we can look for that aggressive trade style, whether you want to be a breakout trader, whether you want to look for the pullbacks to the 8 EMA, whatever it may be. Now, I will say I'm not that aggressive of a trader. I'm typically not looking for these style of trades, so I'm not going to cover too many trade examples of that type in today's video. But basically, long story short, if you are looking for these aggressive trades, like I was just saying, you want to take them as close to the 8 EMA as possible, looking for those pullbacks or looking for that breakout that is relatively close to that average. You do not want to be taking trades super far away from that average because the probability of a pullback is extremely high and you are probably going to get stopped out. Now, one thing you can look for with my style of trading, I like to take reversal trades. We talked about in last week's video, sweep trades, rollover tops, those types of reversals. What you can look for is if you are extremely extended off of the 8 EMA, let's say to the upside, let's say with this example right here, I'll zoom in even closer so we can take a look at it. If you are very far extended, if you have a lot of air between your current price and that aggressive average, and if you start to see that confluence of different signals, like for example, a sweep or like a rollover top or some other signal that is telling you, hey, we might be coming back down. We might be looking for some bearish momentum coming back down to that 8 EMA, or even worse, maybe even back down to the 24 EMA. Then you can use that as kind of a trade, right? You could use that sweep or whatever that is happening as you are very far extended off of that average, looking for a trade to push you back down to that average. I am not the type of trader that is like, oh, hey, look, there's a crossover here. Let me just press the sell button. I don't really take trades specifically based on what is happening on these averages. I just use them as tools to confirm who is in control. As we talked about earlier, we talked about the aggressive traders being in control or the responsive traders being in control. We talked about that a lot in our second video. So I don't blindly take trades just based on the crossovers or a candlestick closing above or below the average. We're more so looking at what is happening when you are X amount of points away from the average, or what is happening when you're the first pullback into the 24, that sort of thing. We're looking at that confluence of all of our different signals happening at the same time. It kind of wakes you up to help you look for these trades. It doesn't tell you specifically to press that button. Okay, sorry, I went on a little bit of a tangent there. Let's go back to what we were saying. So we were talking about that one time framing effect going into the buy side or the sell side very aggressively, which would maintain your price action above that 80 MA. So what happens if you're not one time framing? What happens if the candles are constantly breaking the highs and lows and you're not just seeing a one-sided buy or a one-sided sell? Then you would see price action trading inside of that little gap between the 80 MA and the 24 EMA. This is called a ribbon sometimes because there could be a bunch of moving averages between this 8 and 24, right? There could be a 10, a 12, whatever. Any number between those two averages. There could be many moving averages in between, acting as a moving average ribbon. So if you are testing that kind of ribbon zone, that is more of a responsive zone, right? You're trading into that pullback zone. As we can see, like right here, beautiful pullback into that 24, and then we push into the new high. So if you're not trading very one directionally, you will most often be losing that 80 MA and coming back into that ribbon or coming back into that 24 EMA, possibly for a retest. Now, what you want to look out for, we talked about this a lot in our last video, is if you are constantly testing the 24, kind of like right here when we shifted from more of an aggressive market into more of a kind of neutral market, and then we shifted from that neutral into more of a responsive market right here. And what I mean by responsive is you're not really staying below that 80 MA the entire time. You are constantly pulling back to that more responsive level, that 24 EMA. You're seeing repeated pullbacks either into the ribbon zone or the 24 EMA itself, possibly even seeing traps or breaks of that 24 EMA. Now, when you're in a more responsive market, you want to be a trader who is looking for those pullbacks. You want to look for those pullbacks into the 24, look for the momentum to start coming to an end. We'll talk about the MoMo indicator here in a little bit and how you can use that as confluence. But you want to be looking for that momentum coming to an end on that buy pressure, right? So for example, here, the buyers are coming in. We want to see that buyer momentum start to come to an end, start to curl over, and then we can sell off of that 24. Like I said earlier, I'm not just blindly selling off the 24 EMA. It's just waking me up, telling me, hey, look for the momentum to come to an end around this area. Then pull up your playbook. Is there anything happening that's in your playbook? Maybe a trap, maybe a sweep, maybe some other trades that we'll talk about in the order flow and volume profile series, right? Or videos, I should say. But it's just waking you up, okay? So if you're constantly pulling back to that 24 EMA over and over and over again, you do not, let me repeat, you do not want to be an aggressive trader. You do not want to be selling the breaks of those lows because the market is telling you that you are not in an aggressive market. You are in a more responsive market. They are telling you that by pulling back into that ribbon or that 24 EMA repeatedly. Okay? If it's in a more aggressive market, which it does shift back into, look at this. It goes from hitting that 24 over and over and over again, or the ribbon zone, into staying below the 80 MA the entire time. If you're in a more aggressive market like that, you are safer to trade those breakdowns if you're breaking those clusters of candles like we talked about in the market structure video. If you're constantly breaking those cluster lows, those into lower lows, right? Now, there are many different techniques that I could keep going into with the 8 and 24 here, but it would honestly take up the entire video by itself. So I'm just trying to give you guys a crash course on what you can look for. If you guys want to learn more about how I use the 8 and 24 in my trading, I'm going to put a video up on the screen here in a second. You can click on that. I talk about what to look for with these indicators. So finally, before we move on, I want to get into one more pattern. I want to talk about the traps and how to look out for these traps. Now, I could cherry pick a couple of examples, but these happen so often that I could just show you by scanning through the chart. But what we are basically looking for is something like this, where we are breaking the 24 EMA, or possibly it could be on the 80 EMA as well, but more often than not, it is on the 24 EMA. What you are looking for is when the average is kind of flat and the price action, let's say trending down below it, and then you broke above it and you kind of had that cupping pattern and you re-lost it. One thing you will constantly see with traps, as we're going to talk about with our VWAP traps here in a little bit, is they almost always will have one or two types of patterns. They will have a cupping pattern or a V-shaped pattern. And obviously you could flip the chart and these would be the opposite for the sellers. But it's usually a cupping pattern or a V-shaped pattern. Now, the slower variation of that would be the cup. The more aggressive and faster version of that would be the V-shape. And what you want to look for is when that average is kind of flattened out and you're trending in one direction above or below that average for a while, you try to break it, and then you have that cupping pattern, or you have that aggressive V-shape reversal, okay? And when you have that, it's extremely dangerous for your trades if you're already in a trade. Let's say we took a buy, and price was moving up, moving up, moving up. We're very happy. Our buy is in profit. And we're trying to trail our profit as it's moving up. And we have this moving average slowly following price, so we can just trail our stop loss below that average, right? Very easy. The trap is extremely dangerous if you're already in a trade, because let's say the average is very, very slowly following us. We start to move down and we cup below that average. If it starts to cut below that average and you're trailing your stop loss below that average, that trap is most likely going to stop you out. And I'll always get the question, people will ask, okay, well, how do I not get stopped out on that trap? It is extremely difficult to not be stopped out on that trap if you are trailing. That is quite literally what the trap is designed to do. It is designed to stop out those traders that are trying to trail or trade below those EMAs, okay? They are hunting for liquidity. Some call it a search and destroy algorithm, right? So if you are trailing those averages, if you're already in a trade, for example, let's say if we were shorting here and we were trailing this 24, not getting stopped out here is very difficult. It's probably going to stop you out. The only thing I can tell you is you can base it on volatility. So if it's very high volatility, you could put your stop a bit farther away from that average. So if your standard volatility is like, say, 5 points, then maybe you want to give it at least 5 points away from that average as a protection from those traps. Another thing you could do is, and I really do not recommend this, I almost didn't even want to bring this up, but another thing you could do is you could have a mental stop loss where your stop loss is not actually in the system. You are just saying, okay, in my head, I am looking to get out of this if price breaks above this 24, but you're not just going to instantly close it the second a candle breaks that 24. You are looking to say, okay, when the buy pressure is sustaining, if they're building value above that 24, if they're actually holding above that 24, I will get out of my trade. So it's more of a mental stop loss. It's not actually in the system. Now, why I did not want to bring that up is that is a very advanced thing. I would not recommend that for most traders. You need to be extremely disciplined to use mental stops. If you are not disciplined and you're trying to use a mental stop, what it's going to look like is this. You're going to say, okay, I'm shorting here. I'm in profit. I'm looking to get out on the 24 EMA, but I'm going to do it mentally. So I'm going to see if it holds above that 24. And let's say it does start to hold above the 24 right here. It builds a nice cluster above that 24. But then you're like, I don't really like it. It's not really a strong cluster. I'm going to hold on and wait for a pullback, and we'll see if it goes back down. And then it breaks out to the upside again, and you're like, okay, well, all right, I made the wrong decision, but now I lost all my profit, so now I really don't want to close because I'm not going to make any money. So now I'm going to wait for a pullback, and then I'll finally listen to myself and I'll get out of this trade. Okay, well, now that doesn't happen, and it goes insanely bullish, and now you're extremely negative because you did not have the discipline to close your trade on that mental stop. Okay, so I do not recommend mental stops unless you are an extremely disciplined trader and you can listen to yourself on like a 100% basis. Every single time you say you're going to do something, you do it. Okay, if you find yourself tilting and saying, oh, I'll just wait for a pullback, you do not want to be using mental stops. Okay. All right, going back to what I was saying. If you are leaving your stop in the system, just base it on volatility. If the volatility is, say, let's say an average of 5 points, which, by the way, for volatility, the indicator that I like to use is a ATR indicator. I actually made one on TradingView for free. If you guys type in ATR improved, I have a indicator that I coded for you guys. It's open source. You can see the source code. You guys can use it for free. But base it on volatility. So what the average volatility is, typically I use 5 bars on like a 5-minute or a 1-minute. I just look at like the average volatility on either the red number here or the blue number. If you want to base your stop loss on purely volatility, you can use that number to help you in your trading. But okay, so you want to say the volatility, let's say it's 5 points. You're like, okay, I'll give this about 5 points and I'll put it above that 24 EMA. All right. Very simple system, but I'm just saying that is one way to help you not get stopped out from those traps. Okay, that was a very long tangent. The other thing I wanted to talk about is if you are not in a trade already, what can you do with these traps? What can you do with these cupping patterns or these V-shaped patterns with the EMAs? If you have a trap coming in and you are breaking the 24 EMA and you have that kind of cup and it goes right back down, on that re-entry back below, let's say for the bearish traders here, back below the 24, on that re-entry, if everything looks good on your sell pressure, maybe your other indicators, the momentum looks good, the sweep looks good, maybe there's a rollover top, whatever, right? You're using it as confluence. Like I said, I am not just blindly pressing the button because of these indicators. I use them as confluence. If the confluence is good, if everything is lining up properly on that curve back below that 24 EMA for the bears or back above it for the buyers, you can look for a trade in that general area. Because you are taking the trade based on those traders being trapped. All those buyers that were trading the moving average crossover, or they thought it was going to shift from a downtrend into an uptrend, they just got trapped, and now you are looking to trade that because they are potentially going to get squeezed out. A great example is right here. We had this break above this EMA and then cup right back down, and then you had massive momentum to the downside. So those traders were trapped and then they were squeezed out. Now, one thing I wanted to show in this example and why I don't blindly trade this is look at to the left of this. This is happening repeatedly. It's happening again and again and again throughout this little range here. This is why we don't just blindly trade these traps. We need a lot of confluence, okay? So maybe there was a bunch of confluence here. Maybe there were pivots, which we'll talk about here in a little bit. Maybe you were hitting the value high, etc., etc. If there is a lot of confluence on that trapping pattern, remember, the cup or the V shape on that re-entry, if there's a lot of confluence there, we can take that as a trade, okay? All right, I've spent way too much time on this 8 and 24. I've almost made this the entire video, so let's go ahead and move on. I did not want to spend this much time on this by itself. Let's go ahead and start talking about our other indicators here. All right, just one last reminder, if you want to learn more about the 8 and 24, go watch that 8 and 24 video that I have on my channel. I also have some shorts on using it as well. I didn't plan on spending so much time on that topic before moving on. But let's go ahead and move on to the VWAP traps and the flags. Now, this is something that, once again, I also don't really have to cherry pick examples. This happens damn near every single day. So you can basically find examples of this almost every trading day. We like to use these patterns, or look for these patterns, I should say, on a 1-minute chart. But if you're using VWAP properly, the VWAP should be about the same level no matter what time frame you are looking at. Now, there are two kinds of VWAP that I typically use. I use the daily VWAP and the full session VWAP. The daily VWAP is the one that I consider that it starts at 9:30 at the New York Open, and it goes until the close, about 4 p.m., or if you consider the close like 5 p.m. The full session is the one that starts the prior day at 6 p.m. Eastern, and then it goes all the way until the next day at 4 p.m. Eastern. It's the one that is the actual start of the day for the futures contract. So if you guys hear me reference the daily VWAP, it's the New York Open. The session VWAP is the larger one, the one that goes for a longer amount of time. Now, the types of trades that we are looking for on VWAP are typically VWAP traps or VWAP bull flags or bear flags. Let me just show you very quickly what they would look like for each type of trade. So we talked about the trapping patterns with the 8 and 24, the cupping pattern and the V-shaped pattern. And obviously you can just flip the chart upside down for the bearish ones. But basically what you're going to look for is VWAP is typically very slow. It's very flat most of the time. Even if it's like trailing price, it will be very slow. And what we are looking for on the VWAP is, once again, that cup pattern. So breaking it and cupping back above it. Or the V shape, the very aggressive loss of it, and then reclaiming it. If you are not in a trade already, the way that we can trade these is on that return back above for the buy side or back below for the sell side. Now, what I would consider like the optimal entry point, if you are utilizing the different techniques that we talked about in our last video, like the rollovers and the sweeps. Let's say, for example, VWAP is very flat and we have a cupping trap here. You could possibly have a rollover bottom, or you could maybe even have a sweep down there, and that could be the potential buy. That would be like the optimal entry, the most optimal entry, or the latest entry would be somewhere on the return, the confirmation of that trap once it is returning back to that prevailing trend. So if the prevailing trend was on the upside, and then we tried to lose that trend, but then it returned back above VWAP, confirming that the buyers are still in control, that is where we want to be looking for that buy as well. So potentially the sweep or the rollover bottom down here, or the trap confirmation on that cupping pattern or that V-shaped pattern. Okay, so that is what a trap would look like. Like I said, just flip it upside down for the sellers. For a bull flag, the bull flag would look like this. VWAP would be slowly trending up because obviously you're in an uptrend. A bull flag is when you have a strong impulse up and then a slow pullback back into VWAP. And you want to look to be a buyer on that first pullback of VWAP. Now, sometimes these would both happen simultaneously. You could have a bull flag into VWAP and you could have a trap where it just barely breaks VWAP and then it returns back above it. But we are looking for that first pullback into VWAP after a impulse to the upside above it. The bear flag is the exact same thing, but to the downside. And let me be clear. We want it to be quite slow when it pulls back into VWAP, because if it's very aggressive back into VWAP, let's say it pulls back and then boom, it just bounces right back into VWAP. The more aggressive it is moving back into VWAP, the more dangerous this trade becomes, because a bull flag and a bear flag is kind of a responsive move. It's kind of a slow move. The responsive traders are pulling back to like the 24 EMA or possibly even past it, looking for VWAP. So if it's moving very aggressively, then we want to take a little second, we want to take a break and say, okay, do we want to take this as a bear flag into VWAP or a bull flag into VWAP, or is it too aggressive? Is it possibly going to give us more of a trap or a trend reversal? We want that pullback to be slightly slow, slightly responsive, then we can look for that flagging trade. The more aggressive it is moving into VWAP, the more dangerous that trade is. Okay. All right, now that you know what those trades look like, let's take a look at some examples. So this would be an example of a bear flag into VWAP because we have an impulse down, and then we have that responsive, that kind of choppy pullback into VWAP. Obviously, this line here on my chart is VWAP. This would be the daily VWAP. So when we have that pullback into VWAP, you can start looking for a trade in that general area. You want to see some sell pressure around that VWAP, and with that trade, the target is always the prior low. So whatever the low was before the pullback into VWAP, that is your target. So the bear flag into VWAP, we are shorting the pullback into VWAP. Typically, your stop loss is going to be based on ATR, based on volatility above VWAP. So if your standard volatility is like, say, 5 points or so, you want to be giving it about a 5-point gap between you and your stop loss above VWAP for a bearish trade or below VWAP for a bullish trade. Now, even better than that would be basing it on levels, like maybe some highs are in the area, maybe recent lows, maybe point of origins, maybe value levels, whatever it may be. You want to put it on the other side of those levels so they can protect your trade. And as always, you want to be taking into account your risk to reward. So if you are targeting that prior low for the bear flag trade, and let's say it's 10 points away, you don't want to be putting your stop loss 10 points away or 15 points away. Then your risk to reward is very bad. You want to be looking for that 1.25 to 1.5. So if the prior low, and by the way, we talk about clusters of candles. So the prior low is not exactly just the lowest level before you bounced in a VWAP. I'm talking about the cluster of candles before you bounced in a VWAP. Just the general idea, the general area that created that low before bouncing into VWAP. You want to target that. Okay. So if that is, say, about 10 points away, then we could maybe put our stop loss 5 to 7 points above VWAP for a bearish trade or below VWAP for a bullish trade. Okay. So we look to be a seller on VWAP, looking for sweeps or rollovers or some kind of trade based on our playbook. We'd look to be a seller around VWAP. We target the prior low, stop loss above VWAP based on volatility, based on prior levels, based on risk to reward. Okay. Okay. So in this example, our prior low did get hit, so that target was achieved. Okay, so for our next example, this would be a bull flag into VWAP. So here we have an impulse we have a strong move pushing away from VWAP. And then we have kind of a rollover here. It kind of starts to lose momentum. And you slowly chop your way back to VWAP. Notice how it's not very aggressive on its move back into VWAP. It's not just going straight down into VWAP. It's taking its time and slowly chopping back to VWAP. In this example, this is also a great example of front-running VWAP, where it doesn't quite hit VWAP exactly. It kind of front-runs it by a couple points. Now, these you have to be very careful. If you're looking for that trade on VWAP, it's not always going to be perfect. Sometimes it will go through it by a couple points. Sometimes it will stop above it by a couple points. It's just not going to be perfect. Trading is not an exact science. Okay. So you have to kind of look for that zone around VWAP. So for a bear flag, obviously you are moving down. So you are shorting this. You are targeting the prior low. For a bull flag, you are moving up and then pulling back to VWAP. So you're targeting the prior high. Okay. And once again, it's not an exact science. You're not just targeting the exact level of the prior high. You're targeting more of the zone. Now, yes, if you want to target the exact high, then you could do so. That level could be hit more often than not. Who knows, right? If it's a very aggressive move, then yes, it will hit that level. But if you want to be more conservative, then you want to target probably more the bottom. You could also target somewhere in the middle. It's up to you, right? If you want to look for more points and you want to be more aggressive, look for the exact high. If you want to be more conservative, look for the low. If you want to be somewhere in between, look for the middle. Okay. Trading's not an exact science. Just look for the zone. So bull flag into VWAP. A little bit of a front run. Look for some type of buy that's in our playbook. Maybe a sweep, maybe a rollover, maybe a combo signal, which we'll talk about here in a little bit with the MoMo and OTS. Some type of buy signal in this general area. We are targeting that prior high, stop loss below VWAP. Based on prior levels, based on value levels, whatever it may be, based on volatility, etc. All right. Let's take a look at some more examples. Here's an example of a trap. So we have an aggressive move, a strong move to the downside. We have an aggressive move back up, but it does not stay above VWAP. Now, these traps will make a lot more sense once we talk about order flow in our last video in the series, because order flow is how you determine if the buy pressure or the sell pressure is actually going to stay and it's actually going to continue in that direction. So, for example, if we broke above VWAP here and the order flow was coming in pretty bearishly, then we'd say, all right, it's probably not going to stay above VWAP here, so let's look for a trapping trade. The delta is already very bearish as we are breaking VWAP. So even though we are above VWAP now, all of my signals are pointing down. So I want to look for a bearish trade. And then that confirmation, like we talked about earlier, is that cupping pattern or that V-shaped pattern, cupping pattern or V-shaped pattern back into VWAP. So confirmation would be right here when you re-lose that VWAP. This is more of a V shape. In this case, it's bearish, so you turn it upside down, so it'd be more of an A shape. The letter A, right? You're strongly breaking back above VWAP, but you're not getting the buy pressure to hold above it, and then you are failing back below it. Okay, like I said, it'll make a lot more sense when we talk about order flow, but what you can look for is a trade in that general area, stop above the high, targeting the prior low, as we talked about earlier. All right, let's look at a couple more examples, then we'll move on to the MoMo and OTS. By the way, guys, I know I'm talking very fast and I'm going through all these different things in this video. This series is more of a crash course, so I'm trying to give you a little taste of all the different ways that we use these indicators. It's very difficult for me to cover in detail every single topic around these indicators. I have multiple videos that are over an hour long on all these different concepts, so be sure to check those out in my different playlist on YouTube. And by the way, if you guys enjoy this content, hit that like button, be sure to subscribe. All right, let's move on to the trap here. So we have another trap that is breaking above this VWAP. Very strong move down, strong move up, target the prior low. You don't have a lot of buy pressure holding above that VWAP, target the prior low, stop loss above the high. All right. Here is another example of a bear flag into VWAP. So we have a very strong impulse down. This would be an example of an aggressive bear flag into VWAP. So it doesn't really chop its way back into VWAP. It aggressively moves back into VWAP. Now in this instance, it did still fail VWAP, and you targeted the prior low as we talk about. There's your target. So this one would have been a little bit scary to take at the time because it was so aggressive into VWAP. But if you did look for that sell signal around that VWAP, it did give you a sweep, possibly a rollover top, some other signals, and then you targeted the prior low, which you did hit beautifully. This is an example of if you were targeting a break of the prior low, yes, you did get it by just like a tick or two, maybe a few points. So if you were more conservative and you were targeting that zone, it would have felt a lot more comfortable than getting out on that exact candle low. Okay, so when I say target the prior low, target the prior high, it's more of a zone. All right. Another bear flag there, by the way. And then that one targeted the prior low again. Like I said, I don't have to cherry pick these examples because they happen multiple times a day, at least once a day, typically. Here's a couple more examples of some choppy traps where you're constantly breaking VWAP, but you're just chopping back to the other side of it. This will make more sense in our volume profile series. When you have a D-shaped volume profile and you are rotating back and forth between the value high and the value low, you will get a lot of chop and a lot of traps around these VWAPs. You typically disrespect VWAP and you don't really care about it on these days. Okay, finally, we have a couple more bull flag into VWAP examples here, which are also kind of traps. So we had a strong impulse up. We have that choppy move back down into VWAP. And then we had VWAP act as a support and push us back to that prior high. Now, you could have considered this a trap because you did break VWAP by a little bit before returning back above VWAP and then hitting your target at that prior high. Okay. All right, so moving on to our two most used indicators, the DBT MoMo and the Oasis Trading Suite. These are indicators that I created myself. I created the formulas for these back in 2018. We had some minor adjustments from like 2018 to 2019, but relatively, they are pretty much the same since we created them way back then. And they have been used every single day by many, many traders since then. So they are very, very strong. The DBT MoMo is a momentum oscillator that is modeled off of like MACD and RSI. The formula has nothing to do with those indicators, but those are the two most used oscillators in trading. So I modeled it off of the MACD and RSI, kind of what they were telling traders. So it looks for momentum, it looks for divergences, so bullish divergence, bearish divergence. It looks for traps, like we talked about, the cupping traps, the V-shaped traps. It looks for extensions, etc. For the sake of time, I'm going to be using my write-ups that I have on TradingView on these indicators as a guide for this video. Okay, starting off with how we use the MoMo to read strength, read the actual momentum. There is a price line and a trend line. Now, obviously, one of them is a histogram. It used to be a line. They both used to be lines. That is why it's called the price line. But the histogram is the price line. It takes into account 3 candles. It is a very fast momentum indicator. And then the line is the trend line. It takes into account 24 candles, so a much wider window. How we look at them for momentum is basically how you would read any other indicator for momentum. If it is going up very strongly, it has bullish momentum. If it is going down very strongly, it is bearish momentum. If it's below zero but it's going back up, then the bearish momentum is weakening. If it's above zero and going back down, then the bullish momentum is weakening. Same thing for the line, the trend line. It's just a lot slower. These are put into a range of positive 20 and negative 20 just to keep everything relative. So positive 20 is like the bullish momentum being maxed out, very, very aggressive. Negative 20 would be the bearish momentum being maxed out and very aggressive to the downside. And we are looking for a bunch of different signals on how they are moving together or they are spreading apart, etc., etc. I can't get into every little signal in this video. I have a video that's like, I think over an hour long, possibly almost 2 hours long on YouTube. So be sure to check that out on my indicator playlist. But that is how we are reading them for momentum. Another signal we are using for momentum is when the trend line is staying above the 10 level, but below the 20 level. It's kind of balancing around 15. If it's very flat or just kind of chopping around the 15 level, then it is indicating that there is a strong uptrend. You'll see this a lot with that vertical distribution pattern that we talk about in the second video, in the market structure video. During the vertical distribution, it will be relatively flattened out around 15. So you want to take all those trading techniques that we talked about with being a responsive trader into your consideration. Same thing for a downward accumulation. It will be around that negative 15. It will be kind of chopping around or flattened out at that negative 15 as well. We call this the fish hook pattern, by the way. When it kind of shoots up, it puts in like a cup at around the 20 level or the negative 20, and then it just chops around or flattens out at the negative 15 or positive 15. It's basically telling you, hey, this is a very strong trend. You do not want to be trading against it. You want to be following that trend, basically looking for your responsive signals. Another thing that we use for momentum is the pinch on the MoMo. So the short-term momentum and the longer-term momentum are agreeing on what price is doing. They are pinching together. They are getting to basically the same level, as we can see right here, and they are moving in the same direction. So right here we see bullish momentum coming to an end. Basically it was a trap, and then it started coming back down. The trend line and the histogram are moving at relatively the exact same level, and they are moving very aggressively in one direction. When that happens, you want to be very careful trading against that trend. It means that trend is very, very strong. The longer term traders and the shorter term traders are agreeing in which direction it should move in. Now, obviously, it's based on whatever time frame you're looking at. So when I say long term, I just mean long term for that time frame, taking into a lot of candles instead of only a couple of candles into effect. Okay. Another thing we can look for with this indicator is extensions. So when it is showing a purple shading or gold shading, this would be something we consider is extended. And what we mean by extended is it's just kind of waking us up. It's telling us, hey, this is getting a little bit ridiculous. They probably should be looking for a pullback. That pullback could be just a small pullback, like a profit take, or it could be a very large pullback, which is completely breaking and shifting the market structure, basically creating a point of origin like we talked about on the first video. So these pullbacks could be very small, possibly pulling back to the 80 EMA or the 24 EMA, just a little bit of profit taking, or they could be massive, leading to a major reversal, kind of like this one right here. So what we want to look for is the purple shading shows a possible bullish extension, possibly a pullback into the OTS trail, which we'll talk about here in a little bit, possibly a pullback into the 80 EMA, the 24 EMA, etc. Or it could look for a massive bullish move that will completely break the structure of us being in a lower low structure into a higher low structure. So we could look for a combo signal, meaning confluence with the purple shading and a rollover bottom, possibly a blue pivot, etc. We want to look for different ways that we could get into a bullish trade, or possibly if we are in a bearish trade, we might want to start thinking about taking profit or tightening up our trailing stop losses. The gold shading is the exact opposite. So we want to start looking for bearish trades, maybe rollover tops, maybe sweeps to the downside, maybe tightening up our stop losses if we're already in a strong buy trade. We want to look for those pullbacks into the 8 or 24 EMA, or just a complete failure of the higher high and higher low structure into a lower high and lower low structure. Okay, so we don't always want to be saying it's going to be this massive pullback, this massive market structure break. It could just be a small pullback, but we want to keep that in the back of our mind that it could turn into a very large market structure break. It is basically just waking you up, telling you, hey, let's look for a potential trade. All right. Another thing you want to look for is when these shadings are turning off. So when the Momo is above the positive 10 level, that is what we call finding a top. It is looking for higher value. Once you guys watch my volume profile video, you will understand what I mean by finding higher value. But you're basically saying, hey, we want to look for higher value. We want to look for higher prices. We are finding a top. So when that shading turns off, when that red shading and gold shading turn off because that trend line is breaking back below -10, then we can say the highest point during that shading was the top. They found that top. We can mark that out as a level. We could find the point of origin in that area, mark that out as a level, etc. It's basically just confirming that higher value has been found, and now we want to pull back once again. Could be a small pullback, or could be a complete shift in market structure. All right. So same can be said with the bottom shading. The green shading is looking for a bottom. The purple shading is showing that extension on the bottom, so possibly looking for a pullback. And once that shading has turned off, the bottom has been found, and we can mark out that lowest price as a potential support, or we could go ahead and look for the point of origin on that lowest price and say that is a support as well. So highest point during the top shading is a potential level, and the lowest point during the bottom shading is a potential level. Another thing you want to look for is when the gold shading turns off, but the red shading is still on. That typically means that the short-term momentum is no longer agreeing with that long-term momentum. When they are both above +10, it will be gold. When they are both below -10, it will be purple. So when that gold shading turns off, it is most likely because those short-term traders are no longer agreeing with looking for that higher value. They are pulling back potentially into a support, maybe VWAP, maybe the averages, maybe a point of origin, whatever. So when that short-term momentum starts to pull back, that gold shading will turn off because it is no longer above that +10 anymore. So what we could look for in that instance when we see that gold shading turning off is we could see that price is most likely moving downward into these averages, so possibly a rollover top, possibly sweeps, whatever, right? We could also be using that as an indicator that we are looking for a bull flag and a VWAP. Maybe the momentum is pulling back and then we start to hit VWAP and that momentum starts to come back. It could possibly be showing a trap signal, which we'll show here in a second. It's basically just telling us, hey, the short term is pulling away from the longer term trend. That could be a short pullback, or that could be a very large market structure break. Same thing with the purple shading. If the purple shading is turning off, that means that short-term momentum is pushing away from that longer-term momentum. They are pushing against that prevailing trend. All right. Now, speaking of traps, you have that same trapping pattern on the Momo indicator. So when you have the trend line relatively flat, like we talked about, either in that 15 area or -15 area, but then you have the price line, aka the histogram here. When you have that price line cupping It is a bear trap. The sellers, the bears, are being trapped. It is triggered once it begins to rise again. So once it gets back above that zero line, if it broke the zero line, and then it starts to rise again back above that zero line, it is triggering the trap. Now you could say it's triggered the second it starts rising again, or you could be a bit more conservative and say it's triggered when it gets back above that zero line, or you could wait for it to like relatively look strong again, right? It's basically just telling you, hey, those sellers that were pushing it back down, that's not the real move. That's probably just profit taking. They're gonna get trapped. It's going back up. So you see another one here, strong seller momentum, but on the short term, not on the long term, goes back up. Same thing here. They start to go back up, right? It happens again and again and again. Now for a bull trap, the trend line will be flat at -15. Doesn't have to be exact. It could be relatively around -15, but that shading will still be on. Your price line is pushing aggressively. Your price histogram, right, is pushing aggressively back to the upside, but then it starts to come back down. So you can look for when it starts to come back down right away, or when it gets back below -0 and starts to show that momentum. Now, like I said, I'm not just blindly taking these as trades. I'm using them as confluence. They are waking me up to look for trades based on my playbook. Maybe a point of origin's being retested. Maybe there's a VWAP trap. Maybe there's a rollover. Maybe there's a sweep. Whatever. We're looking for them as confluence. They're just waking us up to those trades. They're not telling us to blindly press the trade button. And lastly, what we can look for is divergence. So what is divergence, if you guys don't know what it is? A bullish divergence is when you have a lower low on price, but a higher low on your momentum oscillator, whether that be MACD, RSI, CCI, the MoMo, whatever. Delta, could be many things. Whatever the oscillator is that you're using will put a higher low in, going against price because price is putting in a lower low. This is known as a bullish divergence, okay? A bearish divergence is when price is putting in a higher high, but the oscillator is putting in a lower high. Now, there are many types of divergence that I'm not going to get into in this video. There's hidden divergence, there's exaggerated divergence, etc., etc. This is the most common that I'm showing you. I'm showing you the basic bullish and the basic bearish. I have other videos that cover divergence. You guys can take a look at those on my channel. For now, we're going to talk about just the basic divergence. By the way, you only want to use the histogram when looking for divergence. You don't want to use the trend line because it was not designed to be fast enough to look for divergence. It will show divergence from time to time, and they do play out, but very often the price line, the histogram, will be showing many more divergences, and it has a higher strike rate. Now, one thing that I show in this example is a multi-peak divergence. It can have many peaks. It doesn't have to be like peak to peak. So it could be like this, where it has peak to peak. It could be the same peak, where it's just kind of going down or going up on the same peak. Or it could be multiple peaks, like kind of 3 peaks. Now, what I will say is the ones that look like this, the triple peaks, quadruple peaks, if they have a lot of price action in between the peaks, it is a dangerous divergence. It doesn't play out as often as the ones that are like this, kind of the peak to peak ones. Okay, so be careful on those. How do we trade divergence? This is, once again, not something that I blindly trade. It's something that I use for divergence. It's something that gives you a little bit of bonus. It's like seasoning, right? It's a little bit of a bonus onto a rollover top trade or a sweep trade or something like that. But basically what we're looking for is, let's say we're taking a sweep trade and you're breaking the high and you're sweeping back below it, and we're already looking to take a bearish trade in that area. And then we look at our MoMo and we're like, oh, also, there is a bearish divergence here. That is a bonus. It just gives you a little bit more strike rate onto that trade. It's going to make that trade a little bit stronger. Now, I'll talk about this more in my order flow video, but back in the day, we used to pretty much blindly trade these divergences on Delta when we had a cumulative Delta bear div or a cumulative Delta bull div. You could pretty much blindly trade those and it worked. That's not really the case nowadays. You kind of have to use it more as confluence. You can't just blindly trade it by itself. There has to be a playbook reason to take that trade. The divergence is just making the trade a little bit better. Okay, moving on to the Oasis trading suite here, another indicator that I created back in 2019, I believe it was. I think it was finalized around like 2019, 2020. This indicator is a little bit different. It's not just used for momentum. It is used for levels, the pivots. Whenever you guys hear me say pivots, it's these blue and orange lines, and they will typically line up very often with the point of origins. So if you guys understand my point of origin method, these pivots will typically be in the exact same area. But basically what they are telling you is where price and volume, a very strong emphasis on volume, is pivoting. It is shifting momentum from one side to the other. Going back to what I talked about early on in the series, pretty much all of my trading can be summed up as a reversal trader looking for shifts in momentum. And that's what these pivots are doing. They are looking for momentum and volume. Like I said, strong emphasis on volume, pivoting, shifting from one direction to the other. And it will put a level in that general area on where that pivot is happening. The other thing the indicator does is it colors your candles based on the overall trend. It tries to be a little bit slow, so it tries to color it in green based on an uptrend, red based on a downtrend, and gray based on no trend, kind of a neutral trend. And then finally, it has what we call a trail, which is basically a moving average. It's a bit more sophisticated than that. It lines up very close with the 24 EMA. It's kind of a responsive trailing level. It's basically telling you if there are responsive pullbacks, this is generally where it's going to pull back to. Okay, let's take a look at some examples here. So the red candle colors here, bearish bias. The green candle colors here, bullish bias. The gray is more of a neutral bias, kind of a sideways market. The pivots, like I said, will look for pullbacks where price is shifting, where volume is shifting. It's pivoting from one direction to the other. It will put a level on that general high or general low. The candle will be colored orange for the top pivots, the ones that are created on highs, or blue for the bottom pivots, the ones that are created on bottoms. And the level will be kind of the highest point or the lowest point based on the candle, but the entire candle is more of a zone. So if you want to think about it more as a zone, kind of like we do at the point of origins, you can mark out the entire candle. So the pivot was formed, pullback was initiated, it puts that level in, you have a breakout of the pivot. So you can trade the pivots with the breakouts or the pullbacks. Like I said, I don't blindly trade these. I just use them as confluence. But you can look for the breakouts of the pivots for momentum using that like aggressive average, like that ADMA or one time framing effect. You can also look for the pullbacks into those pivots for more of the reversal trades to confirm your traps or your sweeps or your reversals, whatever it may be. Maybe there's a bull div, a bear div, etc. Like I said, guys, this is more of a crash course. I have multiple hour-long videos on stuff like this, so be sure to check those out. Once again, breakout of the pivot here. Pivot form, pullback initiated, pullback to a pivot as support. So here's an example of a pivot that you could extend. You could extend that pivot outward as a support zone. We pulled back into it, beautiful wick, and then bounced off of it. Obviously didn't last very long, but it did give you a nice little scalp trade. Here's a bottom pivot. Like I said, they are blue. They're blue if they're forming on lows, which are indicating potentially more bullish trades. And the orange ones are formed on highs, which are indicating typically more bearish trades, but you could also have the inverse happen where they are broken. So like right here, they're unable to break that blue pivot. The trend turned green on the OTS. Put in an orange pivot, instantly broke it. Very, very aggressive. Put another orange pivot, instantly broke it. Also very aggressive. If you want to treat them more as a zone, you can do that as well by drawing out the entire box. What the indicator is doing is it will draw the pivot out and it will stop drawing the pivot once a new pivot of that same color has formed. And this is just there for visual clarity, so you don't have 100 different pivots on your chart. But if you want to extend that pivot, you can manually do so on your charting software, which is TradingView, because these are only available on TradingView, by the way. But if you want to extend it, you can just manually draw a line. When I would say that the pivots are fully used up is when they've been tested on both sides. So like an orange pivot has been broken to the upside and retested to the downside, like by the buyers. So once it's been fully tested on both sides, you can take that level off of your chart. Kind of the same thing we talked about with the point of origin levels. So for a bearish trend, you want to look for breaking blue pivots to the downside, breaking orange pivots to the downside, and not reclaiming them as support. In this example here, we would call this stair stepping, where it kind of creates that stair step where it puts in a pivot, it tries to kind of chop around it, bounce away from it, but then it fails, puts in another cluster of candles, which creates a pivot, fails it again. If you think about this stair stepping candlestick pattern, you put in a cluster of candles, you break down. Put in another cluster of candles, break down. Rinse and repeat, right? What the indicator does, if it's finding those pivots in that area, it will put a pivot near that cluster. You break away from the pivot, rinse and repeat. That's why we call it stair stepping pivots. Okay. So put in a pivot, break, you do not use it as support. Put in a pivot, break, you don't use it as support. But look at what happens on these bottom pivots. Price begins to push away from them as support. So you put in a pivot, you bounce above it, retest, bounce, and then even a bonus, you put in a new pivot, bounce again. Put in another pivot over here, bounce again. So you put in like 4 pivots. There's one here, it's hard to see. 1, 2, 3, 4 pivots in the same general area, and you keep seeing buyers push away from those pivots. You see a lot of sweep trades. Look at the wicks. It might be hard to see in the screenshot, but there are a lot of wicks wicking those pivots. So we talked about those sweep trades in the last video. You can take a lot of those sweep trades around those pivots, right? And then you have the confirmation with the trend turning green and price obviously holding above where the EMAs would be and just trending higher. Looking at the trail, like I said, the trail is pretty much the same as the 24 EMA method. So we're looking for when price is being responsive. It's pulling back to the trail as it would be with the 24. The indicator, the OTS indicator, Oasis Trading Suite, will give you these little arrows, these little triangles. The blue triangles will be when it's sweeping the trail bullishly. The orange ones will be when it's sweeping it bearishly. Basically, sell the rally for the orange ones and buy the dip for the blue ones. Okay. And once again, I keep having to say this because I know people are always going to ask. I do not blindly trade these. I'm not just like, oh, there's a triangle, press buy. It is confluence, right? If everything is lining up for the buy trade, my playbook trades, maybe there's purple shading there, maybe there's a sweep, maybe there's a rollover bottom, maybe there's VWAP support, whatever, right? If I'm getting a bunch of different buy signals firing off, then this is just a bonus. It's seasoning, right? Just a little extra on top. It helps. So when these come in, it just helps you say, okay, maybe the buyers are strong here. They're sweeping that trail. You are holding that uptrend. And then for the orange ones, you are holding that downtrend. Maybe the sellers are strong here. All right, guys, thank you for sticking with me. I know this is long. One more thing. This is a very important section of the video, and then we will call it a video. The last thing I wanted to talk about is that confluence, right? We've been talking about the confluence. What do I mean by that? I'm talking about combo signals. When multiple things are firing that kind of mean the same thing at the same time. And my favorite combo signals that I like to use with these indicators, the OTS and the MoMo in particular, are when they have pivots and when they have shading at the same time. So for example, look at this. Just on last Friday, we had a combo signal on the 30-minute with a blue pivot and a purple shading. What do we talk about with the blue pivots? They happen when price and volume are shifting from the downside to the upside. Whether that's a small shift or a big shift, we don't know, obviously, until we get some confirmation, but it's just telling you that it is shifting from the downside to the upside. There's a lot of buy pressure coming in. Same thing with the purple shading, right? The purple shading and the blue pivot basically tell you the same thing. So the purple shading is also saying that. So if we see them both firing at the same time, that is what we call a combo. They go together. They are giving each other a little bit of a bonus. It's making that trade a little bit stronger. Okay. So one thing you want to look for is we have that purple shading that's kind of waking you up. It's like, all right, hey, look for a potential pullback down here. Look for our buy trades in our playbook. Maybe there's sweeps. Maybe there's overlapping wicks. Maybe there's a rollover bottom. Whatever. It's waking us up to potentially look for a buy trade, or if we're already in a sell trade, we might want to start tightening up our stop losses because this thing might be reversing pretty soon. So once that purple shading comes in, it wakes us up. Then it's saying, okay, the probability of a pullback to the upside is getting very high. So purple shading comes in, blue pivot comes in. We can confirm that with the MoMo by looking at the short-term buy pressure on the price line, aka the histogram. Look at that histogram start to explode here after that pivot. So the pivot comes in right here. Look at that momentum start to explode. It kind of turns into a pinch like we talked about earlier. Okay, so that is a combo signal on the buy side. When you have that blue pivot with the purple shading, and you have that momentum just exploding for the buyers there. We don't see any sell pressure below that pivot. Very good indicator that it's going to be pulling back into the trail or the EMAs, which I could throw on the chart here. So we could keep an eye on the EMAs. We could also keep an eye on that trail, which, like I said, the 24 EMA and the trail are relatively the same. Funny enough, their formulas have nothing to do with each other. They're completely independent of each other, but they do line up with each other because I designed the trail to be around that responsive area. So if I turn off the 24 here, we could say, based on that blue pivot coming in, based on that purple shading coming in, the likelihood of a pullback into that trail is pretty high. If the downtrend was extremely aggressive and you're very far away from that ADMA, you could look for a pullback into that ADMA. Like we talked about earlier, if you're very far away from that ADMA, you're very extended, so we're probably going to pull back into it. So you could use that in your trading, saying, hey, I could be a buyer here looking for a pullback into that ADMA for maybe a small scalp. And then maybe my scalp turns into a really big trade. Maybe we start to break that ADMA. We could look for the trail. Maybe it goes even further than that. Maybe I leave a runner on that trade and it turns into a really big trade, and we can start looking for a break of the trail, which is completely flipping our market structure into higher highs and higher lows. And then we could start looking for that trail as a trail, right? It's called a trail for a reason. We can use that trail to trail our stop loss and continue to follow that trend in the new direction. Okay, so that's kind of how you look at it on a step-by-step basis. The purple shading comes in. The pivot comes in. We can look for a trade. It could be a very small scalp into the ADMA. It could be a medium trade into the 24 or the trail. It could turn into a runner. We could flip the trail and then start using the trail and the EMAs as a trailing runner for my market structure shift trade. Okay, so step by step by step, you are looking for those different flips. All right. The same can be said for the upside. They are also a combo signal for the bears. Okay, so when we are going to the upside and we see an orange pivot come in with a gold shading, and then we start to see that short-term momentum collapsing, it's telling us the same thing. We could look for any of our playbook short signals, a rollover top, a sweep, bearish absorption, whatever, right? It's all confluence. They all go together. We could look for that trade to turn into a bear flag and a VWAP, as we talked about earlier. So we see that gold shading come in. We see that orange pivot come in. We see a sweep of that pivot. Going back to what I said earlier, let's throw on the EMAs again. It could be a trade that just pulls back to the EMA. We take that as a small scalp. It could be a larger trade that looks for the 24 EMA in the trail. It could be an even larger trade to look for a market structure shift into the completely opposite direction. Now, in this example, you get the short scalp. You get the responsive target on the EMA and the trail, but you don't get the runner trade. It actually protects that trail. You get buy signals there. And we're going to talk about another combo signal here in a second. And then it flips back to the buy side. So you do not get that runner trade. Okay. The final combo trade that I want to talk about is exactly what I just showed. It's the trap combo. So the trap combo is when you have that trap signal on the MoMo that we talked about earlier. We have that flat trend line. We have that cupping pattern on the short-term momentum. And then you also have the trap signal on the OTS. You have the pullback signal on the trail, the buy the dip signal in this example. So we have the buy the dip on the trail and the trap signal on the MoMo, and look at how good that trap trade is. Like I said, guys, it's all confluence. It's all these signals happening at the same time. This could have been a bear flag, or excuse me, this could have been a bull flag into VWAP, which let's just put on VWAP. Let's take a look. Is it? Is it a bull flag into VWAP? It is. Funny enough, there's VWAP as well. So look at the confluence on this trade. Look at everything lining up in the same way. We have the bull flag into VWAP. We have the trail signal giving us buy the dip signals. We have the trap confirmation on the MoMo, which I will agree that in this example, it is a little bit late. It gave you the trap confirmation right on this candle. So it was a couple candles late. But you had everything lining up pretty much at the same time. Bull flag into VWAP, sweeping the OTS, buy the dip signals, and you had the trap signal on the MoMo. That's what we call confluence, right? Everything happening at the same time, hand in hand, telling you you're better off being a buyer. You are not better off being a seller in this instance. Okay, guys, I know this video was a lot. I know I just threw a ton at you. Like I said, this series is more of a crash course. I'm trying to give you a little bit of everything. I know this was a whole lot to digest. I apologize for that. Hopefully it all made sense. If you guys didn't understand anything, please put your questions down below and we will get to them during the Q&A. And by the way, if you guys don't understand anything from these series videos, if there's little things that you're not really getting, be sure to check out the Q&A video. We're making a Q&A video for every single series video, and that might answer your questions. And for next time, we will be talking about volume profile. So if I talked about any volume profile terms up until this point that did not make any sense, be sure to tune in to our next video. We will be talking about volume profile shapes, how we use them in our trade plans to find our bias, how we use them for our levels to watch with like the value highs, the value lows, the POCs, maybe even the LVNs, and what type of trades we can take on the volume profile as well. Finally, quick reminder for the giveaway. If you guys want to get entered, just be sure to follow what is on your screen right now. If you guys enjoyed this content, please hit that like button. Be sure to subscribe. I appreciate you guys sticking out until the end, and I'll see you guys in the next one. Peace, everybody.